I'm Ben Summers, the founder of Adagio Group and executive director of Adagio Institute. I want to share with you my journey around the world. It's a journey that took me from professional baseball on the West Coast to apply my physics degree to the anti-intellectual business of energy services in Texas, West Africa, where I too often found myself at the literal point of a gun, and Northern Europe, where sailing the Norwegian fjords is awesome. Then to the entrepreneurial focus of real estate investing, fund management, and ultimately running my own quant-based boutique investment bank from here in South Florida. I think you'll find this journey of interest, but more importantly, I think you'll find the lessons I learned very helpful as you strive to grow your own business. It was November of 2004. Just a couple years previously, I was getting well paid to throw a baseball in front of thousands of people. At this particular moment, however, I was being held at gunpoint in an old, flat-bottomed boat in the Niger Delta by a group of Nigerian armed youth. How did I get here? The thoughts flooded in, but one stood out above the rest. I wasn't getting paid enough for this shit. At that point, I decided that no matter how prestigious my position in the global energy services industry, I needed to take control of my own destiny. So I committed to starting my own business. I knew that startup capital was the biggest hurdle for new businesses, and over the years, I'd also learned that creative finance minimized the need for startup capital. So the decision was made. When I returned to the US after my sixth 3-month rotation in Nigeria was complete, I registered my new business, Adagio LLC, as a real estate investment company on May 11, 2005. The name Adagio, which refers to the slower, expressive second movement of works in classical music, represented my attempt to bring the beautiful incorruptibility of music that I experienced during my formal education to the culture of business. It wasn't long before my idealistic enthusiasm took a hit by reality. There were a whole lot of people chasing very few good deals. But the effort that led to that disappointing realization also exposed me to another eye-opening discovery: the hard money lender. There were these hard-to-find individuals who would lend to real estate investors at exorbitant interest rates for short periods of time. To protect their loans, not only did they demand the borrower to personally qualify, but they also limited their LTV to around 65%. They couldn't lose. If the borrower paid as promised, the lender made close to 20%. If the borrower defaulted, he made even more. It was a perfect win-win. This was the side of real estate I knew I needed to be in. I also knew that being a lender meant that I would need a lot of money, much more than I had at the moment. When I looked at the returns and almost non-existent potential downside of the hard money lending business, I intuitively knew that this was a much better deal than the stocks and bonds being peddled by local financial advisors. I just needed to convince others of this so that would allow me to put their money to work for them. You'd think this would have been an easy task. It was not. Securities regulations make it almost impossible for a beginner to raise capital, and even if you can navigate the regulatory gauntlet, belief is a difficult thing to change, especially belief about investing. It took time and work, but eventually I was able to convert my idea to start a hard money lending business into an institutional grade fund that thrived even during the 2008 financial crisis. My goal is to help you do the same. I was ecstatic to have discovered a great investment model that few people knew about. Returns were much higher than the stock market without the constant downside risk. As I told people about it, I expected everyone should be lining up to have me put their money to work. But they didn't. No one. Not even my dad was willing to invest a penny with me. I was missing one huge idea. The business of raising money is the business of finance. It seems like a fairly obvious idea now, but when I was buried in the real estate business, inundated with guru courses, realtor propaganda, and the pseudo-sophistication of commercial real estate, that fact got lost. Fortunately for me, my sister happened to be dating the guy I needed to meet. He was not only a securities attorney with a law degree from Vanderbilt, but he had also worked as both a portfolio manager at one of the big investment banks and as an analyst at a hedge fund in New York. When I met him, I expressed my frustration with my inability to convince anyone to invest with me. His initial response was disbelief. Not that people wouldn't invest, but that this investment model called hard money lending actually worked. It just so happened that not too much later, he wound up leaving his job on Wall Street. He got shorted on a bonus, and that was the last straw for him. I persuaded him to come down to Florida with me to see what real estate investing and hard money lending looked like firsthand. What he witnessed shocked him. I'll never forget what he said once he finally realized what I had introduced him to. This is the fucking Wild West of investing. Now I was shocked. He made me realize that not only do real estate people not know anything about finance, but finance people don't know anything about real estate. With my knowledge of real estate and his knowledge of both securities law and hedge fund operations, we partnered to take advantage of this industry divide. We built out Adagio from a single entity private investment company into an institutional grade fund manager. I took this opportunity to dive into finance, pick my partner's brain, and learn everything I possibly could. I read everything from the full set of federal securities laws, the Chartered Financial Analyst or CFA exam manuals, and Nassim Taleb's Inserto, to G. Edward Griffin's The Creature from Jekyll Island, and the works of Mises and Hayek. Not only did I learn the business of finance and pick up a FINRA Series 65, which is the Uniform Investment Advisor law license, but I also became an advocate for Austrian economics along the way. While there's an endless amount of information to digest, I came into this effort with the hardest part already down: math. My degree is in physics with a minor in music, which requires fluency in mathematics. So when it came to quantitative finance, all I needed to know was which ideas needed translation into numbers. The application of formulas came easy. One formula not even my well-credentialed partner thought to bring to our efforts was the Capital Asset Pricing Model, or CAPM. Well, that's a mouthful that might sound like a turnoff at first. It communicates one of the most important measures of an investment, the return it should generate given its market risk. It's worth noting that I discovered even more informative third and fourth order risk-adjusted performance metrics later on, thanks to Nassim Taleb. Armed with these mathematical tools, I can now convert my intuitive feelings about the merits of real estate investing into meaningful financial terms. Even better, I was now able to utilize financial instruments, such as derivatives, to even further improve the risk-adjusted returns of common real estate investing strategies, from the basic hard money lending model to taking advantage of arbitrage opportunities between price and value. Unlike financial professionals, no one in real estate knows how to price financial instruments, or even cares for that matter, and this creates tremendous opportunity for those who can. For example, I was able to buy a simple call option on an undervalued $2 million property for only $5,000. The result, I was able to capture $500,000 in forced appreciation in under 12 months with nothing more than a meager $5,000 investment, and none of the risk associated with holding legal title. For those who are counting, that's a 10,000% annualized return. It's like betting only $1 on a coin flip and winning 100 if you guess right. I had all the pieces in place. Well, all but one. There is one set of numbers that hold the key to protecting real estate investors from down markets. They hold the key to raising unlimited capital. I discovered these numbers just in time to make my investment business thrive during the 2008 financial crisis. These numbers should be highly valued by everyone who participates in the real estate investment market, especially commercial operators and brokers, but they're not. So in 2008, while everyone else who was invested in real estate, including the hard money lending crowd, suffered terrible losses, our lending fund generated returns in excess of 30%. 2009 was even better. When I started investing in real estate as a career in 2005, I immediately noticed that it seemed very difficult to find properties that generated substantial positive cash flow. At that time, I knew nothing about monetary policy or risk engineering, but I did know that residential properties were generating less income per purchase price, NOI, than what was described in the books I had read on the subject. Those books were written about a decade previously, and something had changed. Something big. But what? I started researching real estate data. Right around the time I was about to launch my lending fund in 2007, I came across a chart that illustrated two sets of very important data published by the U.S. Bureau of Labor Statistics and the Federal Housing Finance Agency. They were owner equivalent rent versus the housing price index. This is what I found. This chart showed something amazing. Until 1999, rental rates and housing prices grew in tandem. This had been true going back over 80 years, but starting around the year 2000, housing prices began to run away from rents. What was happening? I didn't know for sure, but for me, it validated the whispered talk I'd heard from some financial professionals about real estate being in a bubble. From that day onward, everything changed. This one chart would eventually take me from being just another real estate investor to running my own investment bank, arguably the most coveted position in business. The first thing I did was to stop listening to all the realtors and the lenders and the other real estate investors, and I started watching the numbers. I'd already seen that hard money lenders had a really good business model, but I recognized that even they were making a mistake. Their 65% LTV seemed like a conservative bet, and it would be at any other time in history, but if the rental data was to be believed as the fundamental measure of value, even they were overexposed. My next question was, how do I take advantage of this fairly big gap between housing prices and rent? The answer was still lending, but with a twist. Instead of lending at a fixed loan to value as a percentage, I decided to lend as a multiple of the property's market rent. By making this one change, what I had inadvertently done was almost completely eliminate market risk from my portfolio. At the time of this transition, real estate was already on its way down, but all the market participants were blind. They remained in full-blown denial about how bad things could and would get. Meanwhile, despite all the pressure to do otherwise, I maintained my ground and stuck to financing only the transactions that allowed me to apply my strict rule of valuing property as a fixed multiple of its market income. Realtors, property sellers, other investors, they all thought I was ridiculous. No one else was being so conservative. Even the Fed chairman was pronouncing the market to be fundamentally strong. But I would not back down, and thank God I didn't. Soon afterward, not only the real estate market, but the entire financial system was collapsing. It was September 2008. Iceland was already headlong into their financial crisis when I was sitting on a friend's couch in Aberdeen, Scotland. We were watching CNN declare that across the pond, Lehman Brothers had filed bankruptcy. It seemed like everyone was losing everything. Everyone but me. My portfolio's 2008 returns? 32.07%. My commitment to faith in numbers had paid off. While the market value of the properties I invested in fell, there was still ample income and equity above my position that allowed me to exit almost exactly according to plan. The best part was that with the collapse of the financial system, no one had money they were willing to lend. No one but me. My portfolio's 2009 returns? 41.56%. During this process, I mastered quantitative risk analysis and developed my own risk rating matrix that captures all aspects of risk, from second-order market and total risk expressed as the Modigliani measure to the tail risk impacts of market crises via the omega ratio. I immodestly named it the Summers Alternative Risk Rating. Without diving into the technicalities, all these calculations effectively tell you the same thing. The less the price of something changes, the less risky it is as an investment. And as you can see in the chart, residential real estate income doesn't change very much, at least not when compared to other assets. I also continue to develop my skills of managing risk with fundamental valuations, capital structure, and derivatives, such as options and swaps. I soon realized that what I had done with my real estate fund in terms of protecting it from market risk was the holy grail of Wall Street. I thoroughly understood private securities law and the mechanics of raising capital. I thoroughly understood risk engineering, and I had a very stable asset to build everything on: rental income. I was now equipped to compete directly with Wall Street. Instead of being relegated to competing for the few investors who are willing to passively invest in real estate, I could now issue securities that were verifiably better than just about everything else available, from Apple stock to U.S. Treasury bonds. I could go head-to-head with any asset manager regardless of asset class. In 2016, I wound down my primary fund and restructured my business into a boutique investment bank so that I could apply all that I learned to help other real estate asset managers take advantage of our unique opportunity. Shortly thereafter, we began working with brilliant asset managers in just about every asset class imaginable, from the most sophisticated synthetic risk transfer to well-engineered quantitative equity strategies that were able to generate better risk-adjusted performance than what could be found anywhere else. As most people know, securities laws are extremely complex and vague. This dynamic creates a trap that unsuspecting business owners often fall into unwittingly. Once ensnared, it can be nearly impossible to escape unscathed. It is illegal for certain types of private funds to advertise for investors. For the type of funds I manage, securities law requires us to have a pre-existing relationship with an individual before we can introduce our offering. As a means to establish these pre-existing relationships with the right investors for our funds, I developed a comprehensive course, the Accredited Investment Professional, or AIP. It was designed to accomplish a few different things. First, to educate real estate investors and agents on the financial concepts used by Wall Street to raise unlimited capital and effectively manage risk. Secondly, to educate high net worth individuals on how to evaluate investments in terms of the only three variables that matter: risk, return, and liquidity. And third, to create brand awareness for our firm by communicating our unique expertise. One thing I quickly found was that people really don't like making the effort to learn. The second thing I found was that once people read the AIP course syllabus, they recognized our expertise could help them tremendously. One day, I received an inquiry that seemed a little different from the others. Our course whiteboard advertisement had landed in the hands of a multifamily, deep value-add operator who was in desperate need of help. They were being investigated by several states in addition to the SEC for illegal fundraising activities. And to make matters worse, their portfolio was insolvent, meaning they owed their debt investors more than their assets were worth. We worked with them for over a year to restructure their capital stack and methods of raising money. A little later, we'll provide you an opportunity to access the case study that anonymously details the circumstances and the mechanics of how we rescued this firm from the brink of bankruptcy and prison to compliantly and profitably raise over $5 million a month. All of my expertise and resources worked in concert to eliminate their regulatory burden, greatly improve their profitability, protect them from market risk, and raise unlimited capital. I wondered how many other alternative asset managers were unwittingly heading down a similar path. I could save them a lot of money, a lot of stress, and help them grow exponentially faster, a lot sooner, if they would work with me from the time they were first starting out instead of after they found themselves stuck in a position where they couldn't raise the capital they need, or worse, facing legal and financial crises. From that point on, I decided to make this effort my primary business, to apply my unique skill set to help every serious alternative asset manager I could maximize their potential to pose a serious threat to the dysfunction and the corruption of Wall Street. I liquidated my primary fund to remove conflicts of interest and restructured Adagio into a de facto boutique investment bank. So now I can. Adagio now engages in a full complement of financial services, providing third-party quantitative risk analytics, institutional-grade fund management, and boutique investment banking services to the alternative space. Whether you're a saver with a nest egg that you need to safely generate income, a relationship builder, or you're already in the investment business, we've got uniquely powerful solutions for you to achieve financial independence. Just imagine what life will be like when you're free from the boom-bust cycle and have the power to create all the capital you can responsibly use, just like the banking system. I've taken everything I've learned and packaged it into a single book, and I'm excited to share it with you today. It's a book that will show you how to protect your investment portfolio from market crises while generating above-market returns. It will show you how to create capital and become your own bank. This book is called The Shadow Banker's Secrets: Investment Banking for Alternatives. It will teach you how to generate the investment returns you need without the risk you've been told you have to accept. how to access and even structure investments that are objectively better than the mutual funds, annuities, and real estate deals being peddled by glorified salesmen. And for the asset managers struggling to scale their portfolio, this book will show you how to raise capital at scale by meeting institutional grade standards, clearly communicating the merits of your strategy in accurate, objective terms, and fully accessing the capital markets in a compliant manner. This book covers why you need to measure risk-adjusted investment performance, how to definitively evaluate investments, how to generate strong investment cash flow and growth that won't take a hit from market crises like 2008, how to access exclusive institutional-grade private investments without having to be accredited, how to quickly grow your investment portfolio and compliantly raise capital at scale, even if you don't have a FINRA license, how to profit from compliantly providing other investors access to exclusive institutional-grade investments, and ultimately, how to become your own bank. For a limited time, I'm making this book available in hardcover with free shipping at an extraordinary discount. You'll also have a one-time opportunity to upgrade your order with immediate access to the book's companion masterclass at an even bigger discount, which includes a private strategy session with me to help you apply what you learned to your specific circumstances. If you want to turn the tables in the banking industry, this is your time, and this is your opportunity.